to the GEX Private Equity Academy podcast. I'm Vanamali, CEO of GEX Management, managing partner of GEX Capital, and the founder of the GEX Private Equity Academy. Today, I would like to answer a question that I hear quite frequently. What makes a business attractive to private equity? Many people assume private equity firms are simply looking for the biggest companies, the fastest growing companies, or the most profitable companies. While growth and profitability certainly matter, experienced investors evaluate businesses through a much broader lens. When we are evaluating acquisition opportunities, we are trying to determine whether a business possesses the characteristics that can support attractive long-term investment returns. Today, I would like to walk through some of the factors that we commonly evaluate while reviewing acquisition opportunities. Let's start with the industry. One of the first things we evaluate is the market itself. Is the industry growing? Are there favorable long-term demand drivers? Are there trends that are likely to support growth over the next 5 or even 10 years? For example, many investors are attracted to industries that benefit from demographic shifts, technology adoption, outsourcing trends, or favorable regulatory environment. A great management team operating in a declining industry may still face significant challenges. On the other hand, a good business operating in a growing industry often benefits from favorable tailwinds. Industry matters. The second factor is recurring and predictable revenue. As investors, we generally prefer businesses with revenue streams that are stable and predictable. And why is that? Because predictability reduces risk. Businesses with recurring customer relationships are often easier to forecast than businesses that depend entirely on one-time projects or transactional revenue. That does not mean project-based businesses cannot be attractive. Many of them are, but all else being equal, predictability tends to support valuation. The third factor is customer diversification. And this is a topic that comes up repeatedly when I'm evaluating businesses, and one that we discuss frequently in the case studies. If a company loses its largest customer, what happens? Does the company continue to operate normally, or does performance change dramatically? Generally speaking, investors prefer businesses that are not heavily dependent on a small number of customers. Customer diversification often reduces risk and increases stability. The fourth factor is competitive positioning. What makes the company different? Why do customers choose this business instead of the competitor? Does this company have specialized expertise, long-standing customer relationships, maybe a differentiated service offering, operational advantages, intellectual property? Businesses with sustainable competitive advantages are often better positioned to defend their margins and retain customers over time. The fifth factor is management. Private equity firms don't just invest in businesses, we invest in people. Can the management team execute? Can they scale the organization? Can they lead the company through its next phase of growth? A strong management team can significantly increase the attractiveness of an investment opportunity. The sixth factor is profitability and cash flow. Of course, revenue matters, EBITDA matters, but equally important is understanding how efficiently the business converts earnings into cash flow. Cash flow supports growth initiatives. It funds acquisitions. It allows debt to be repaid. And ultimately, it's one of the primary drivers of investment returns. The next factor is value creation opportunity. This is one of the areas where private equity investors often think differently than any other buyer. We are not simply evaluating what the business is today. We are evaluating what it could become. Can we improve operations? Can we professionalize the organization? Can we expand geographically? Can we introduce new service lines? Can we complete strategic acquisitions? Many of the best investments are not perfect businesses. They're businesses with clear opportunities to create value. Finally, we evaluate risk. Every business has risk: customer concentration, supplier concentration, employee concentration, industry disruption, regulatory changes, management dependency. The objective is not to eliminate risk. That is impossible. The objective is to understand it before making an investment decision. Great investors spend just as much time evaluating downside scenarios as they do discussing upside opportunities. So, what makes a business attractive to private equity? There is not a single answer. In most cases, attractive businesses possess a combination of favorable industry dynamics, predictable and recurring revenue, diversified customers, sustainable competitive advantages, strong management, healthy cash flow, clear value creation opportunities, and manageable risk. When those characteristics come together, investors become interested. But as we will discuss throughout this podcast series, identifying an attractive business is only part of the equation. The next question is just as important. Does that business represent an attractive investment at the right valuation? And that is where private equity investing becomes both an art and science. Thank you for joining me for this episode of the GEX Private Equity Academy podcast. If you would like to continue learning how private equity investors evaluate real lower middle market acquisition opportunities, I invite you to join the GEX Private Equity Academy Insider List. As an Insider List member, you will receive our complimentary Private Equity Starter Kit, transaction insights, educational resources, and invitations to select live private equity case study sessions. If you found this episode valuable, I would also appreciate if you subscribe to the GEX Private Equity Academy YouTube channel so you do not miss future podcast episodes, acquisition case studies, and other educational content. To learn more or to join the Insider List, visit www.gexprivateequityacademy.com. Thank you again for joining me. Until next time, keep asking better questions, keep evaluating opportunities, and remember, do not just look for great businesses, look for great investment opportunities. Thank you.